Today, we're diving into an essential topic: financial mistakes you should avoid in 2025. Whether you're just starting on your financial journey or you're a seasoned expert, these tips are crucial to steering your ship toward financial security. So let's jump right in. First on our list of financial pitfalls to avoid in 2025 is the classic trap of overspending, particularly lifestyle inflation. So what is lifestyle inflation? It's that tendency to increase your spending as your income rises. While it's natural to want to enjoy the fruits of your labor, unchecked lifestyle inflation can prevent you from reaching long-term financial goals. When your earnings grow, it's tempting to upgrade your lifestyle by buying nicer things or dining out more frequently. But doing so can trap you in a cycle where you're always living paycheck to paycheck, no matter how much you make. To secure your financial future, try to maintain a budget that prioritizes savings and investments over fleeting luxuries. Tips: clearly distinguish between needs and wants. Needs cover essentials like housing and groceries, while wants include those nice-to-have items that aren't necessary. Automate your savings. By setting up automatic transfers to a savings account or investment fund as soon as you get paid, you won't be tempted to spend money that would be better saved. It's all about balance. Enjoy your hard-earned money, but ensure you're planning for future security at the same time. Making small adjustments today can yield significant benefits down the road. Now let's delve deeper into why neglecting an emergency fund is a financial mistake you'll want to avoid in 2025. An emergency fund is your financial safety net, ready to catch you when life throws unexpected expenses your way. Without it, you might find yourself relying on high-interest credit cards or loans, which can quickly spiral into debt if not managed properly. Think of those sudden car repairs, medical emergencies, or even unexpected job losses. These situations can arise at any time, and having an emergency fund ensures you're prepared without having to compromise your financial stability. So, how much should you save? A good rule of thumb is to have 3 to 6 months' worth of living expenses set aside. This might sound daunting, but start small and build gradually. The key is consistency. Even small, regular contributions can grow into a substantial fund over time. Establishing your emergency fund should be prioritized over other savings goals because it creates a financial cushion that keeps you afloat during rocky times. One strategy to ensure growth is to keep this fund in a separate account, preferably a high-yield savings account. This way, your money remains accessible without the temptation to dip into it for non-emergencies. It's important to reassess the size of your emergency fund annually or whenever you experience significant life changes, like a new job, marriage, or moving to a new city. Make it a priority in 2025 to build and maintain a healthy emergency fund, providing you peace of mind and financial flexibility for whatever life throws your way. In short, neglecting an emergency fund is like choosing to walk a tightrope without a safety net. By prioritizing this financial fundamental, you'll navigate life's uncertainties with confidence and security. So take the necessary steps this year to create or bolster your emergency savings, ensuring you're equipped for the unexpected. As we move into 2025, it's crucial to understand the impact of inflation on your finances. Inflation is the rate at which the general level of prices for goods and services rises, subsequently eroding purchasing power over time. Ignoring inflation means underestimating how much more you'll need to spend to maintain your current lifestyle in the future. Historically, inflation averages about 2 to 3% per year, but in the short term, it can be higher or lower depending on economic conditions. While this may seem minimal annually, over time, inflation significantly decreases the value of your money. For example, if you're not adjusting your savings to match or outpace inflation, you could find yourself facing a financial shortfall when you need those funds the most. One common financial mistake is leaving too much money in standard savings accounts. These accounts typically offer interest rates that are lower than the inflation rate, effectively decreasing your money's buying power year after year. To counter this, consider investing in assets that historically outpace inflation, such as stocks, real estate, or inflation-protected securities. Budget adjustments are another crucial area. It's vital to periodically review and update your budget to reflect rising costs. This ensures that your expenditures are aligned with your income and that your savings and investments are growing sufficiently to cover future expenses. Moreover, understanding inflation can aid in negotiating salaries or setting prices for your services or products. Asking for a raise based on inflation rates ensures that your real income isn't diminishing over time. Similarly, if you run a business, adjusting prices accordingly helps you maintain profit margins. Looking ahead, inflation should never be an afterthought in your financial planning. By incorporating strategies to combat its effects, you can safeguard your purchasing power and ensure your money grows effectively over time. Remember, ignoring inflation is essentially ignoring a silent paratrooper that eats away at your future savings. In 2025, make inflation awareness a priority in your financial strategy to maintain and grow your wealth successfully. Next, let's address a critical mistake that many investors make: failing to diversify their investment portfolios. Diversification is a key principle of investing that involves spreading your investments across various asset classes to reduce risk. As we look forward to 2025, understanding and implementing diversification is more important than ever. Imagine putting all your money in just one stock. If that company performs well, you might see significant gains. However, if it performs poorly, you could face substantial losses. This is where diversification comes into play. By allocating your assets across different investments, such as stocks, bonds, real estate, and commodities, you can minimize the risk of any single asset negatively impacting your entire portfolio. Diversification is not just about having a mix of different assets. It's about having a mix that aligns with your risk tolerance and financial goals. Stocks, for example, are known for higher returns, but come with higher risk. Bonds, on the other hand, tend to be safer, but offer lower returns. Real estate can provide passive income and is often considered a hedge against inflation. For example, in 2025, you might consider diversifying not only across asset types, but also geographically. Investing in international markets can open up opportunities unavailable in domestic markets and can provide a hedge against local economic downturns. Moreover, regularly reviewing and rebalancing your portfolio is crucial. The market doesn't stay the same, and neither should your portfolio's composition. Rebalancing involves adjusting your asset allocation back to your intended targets as various investments perform differently over time. This strategy ensures that you continue to manage risk effectively and adjust to changes in the market environment. Remember, while diversification doesn't guarantee against losses, it is a powerful tool for spreading risk across various investments and increasing potential long-term returns. Neglecting to diversify can leave you vulnerable to market volatility and the financial health of individual investments. As you plan your investment strategy in 2025, aim for a balanced portfolio that aligns with your financial goals and risk appetite, helping secure a stable financial future. Now let's delve into a mistake that's easy to overlook but can have long-lasting impacts: disregarding retirement savings. With the hustle and bustle of everyday financial responsibilities, saving for retirement might not seem urgent, and especially if you're far from retirement age. However, failing to prioritize these savings can jeopardize your long-term financial security. In 2025, it's important to start thinking of retirement savings as a crucial and immediate financial goal. The earlier you start saving, the more you can take advantage of compound interest, which is essentially earning interest on your interest over time. This can significantly amplify your savings, giving you a much more robust financial cushion when you retire. One common oversight is not maximizing contributions to retirement accounts. If your employer offers a 401k plan with matching contributions, make sure you're contributing enough to get the full match. That's essentially free money. Beyond employer-sponsored plans, individual retirement accounts like IRAs offer tax advantages that can further enhance your savings. It's also important to periodically evaluate your retirement plan to ensure it aligns with your evolving financial situation and retirement goals. Life changes, such as marriage, having children, or receiving a higher salary, might necessitate adjustments in how much you should be saving and investing for retirement. Think of your retirement savings as not just a distant goal, but a priority that requires ongoing attention and effort. Automating contributions can help you commit to saving consistently without having to think about it monthly. Additionally, consider diversifying your retirement savings portfolio to reduce risk and increase potential growth. This might include a mix of stocks, bonds, and other investments, depending on your risk tolerance and investment horizon. Ignoring retirement savings now can lead to a future where you might have to work longer than planned or make significant lifestyle adjustments to make ends meet. By prioritizing your retirement savings in 2025, you're ensuring greater financial freedom and security in your later years, allowing you to maintain your desired lifestyle without financial stress. Take action today to review and enhance your retirement savings strategy, making sure that it supports your vision for a secure and enjoyable retirement. Finally, let's discuss a mistake that can derail even the savviest of financial plans: falling for get-rich-quick schemes. In 2025, as new technologies and markets emerge, the allure of quick wealth often tempts many into risky and dubious ventures. These schemes promise significant rewards with minimal effort, but they often lead to financial ruin rather than riches. The premise of a get-rich-quick scheme is simple: make a lot of money quickly with little risk or work involved. However, if something sounds too good to be true, it probably is. These schemes often target people's desires to improve their financial situation rapidly, but are usually built on shaky foundations, lacking legitimate business or investment plans. Common get-rich-quick tactics include pyramid schemes, Ponzi schemes, and certain types of multi-level marketing. Additionally, with the rise of digital currencies and blockchain technology, numerous scams have emerged, promising high returns for early investors who often lose their money as the schemes collapse. To protect yourself, it's essential to approach every opportunity with skepticism and due diligence. Research thoroughly before investing your money. Look for reviews, verify business credentials, and seek advice from financial professionals. Be wary of opportunities that rely on recruiting new participants or require upfront investments for vague promises of future returns. Furthermore, maintain a fundamental understanding of where you're putting your money. If you can't explain an investment or business model clearly, it's likely too complex or misleading. Sound investments don't require secrecy or unverifiable guarantees of high returns without risk. Educating yourself is the best defense. Understanding how legitimate investments work helps differentiate between a real opportunity and a scam. If someone pressures you to make quick decisions or doesn't offer clear, consistent information, these are red flags that shouldn't be ignored. Remember, building wealth typically requires time, effort, and strategy. So in 2025, commit to developing long-term investments and savings plans based on sound advice and proven financial principles. By doing so, you'll be better prepared to spot and avoid the traps of get-rich-quick schemes, securing your financial future on a solid foundation rather than risky shortcuts. Invest in what you understand and be patient with your financial growth journey. Thanks for watching. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more insightful content every week. What are some financial mistakes you think people should avoid? Let us know in the comments below. Until next time, stay smart and stay safe with your finances.